We're about to witness a historic supply and demand shock in the stock market on a scale that Wall Street has never seen. Led by a massive $75 billion SpaceX offering, a wave of mega capital raises is forcing institutional funds to liquidate existing positions just to get a seat at the table. Is this the reality that hit the markets last week and caused the sharp sell-off on Friday? Hi, I'm Brian. I'm an investment advisor. I manage portfolios for investors like you. Let's talk market forces. These are the 5 market forces I want to highlight today. The stock market just priced in higher interest rates. Why higher interest rates are a risk for the economy and the stock market. And a prominent UK investment bank said, quote, "The hyperscalers are a house of cards," end quote. SpaceX could change the market. And some side notes, exactly how overvalued is Microsoft? An investment advisor who fled police on an underwater scooter who was running a Ponzi scheme. More proof that AI is not taking your job anytime soon. And 5 documents you need to have in your estate plan, according to the Wall Street Journal. Before I jump in, just a reminder, I don't provide investment advice on YouTube. Your portfolio should be customized to your personal expectations and your risk tolerance. Contact me directly anytime if you want a free professional analysis of your portfolio. And if you have any holdings you'd like me to take a look at, please let me know that. If you want to share your thoughts or just have a question, maybe there's a topic you want to cover in another video, just let me know. Now let's get to the market forces. The stock market just priced in higher interest rates. Last week, the stock market got a reminder that liquidity matters. Low interest rates, loose monetary policy, and government spending have been a steady tailwind for the stock market for nearly 2 decades. On Friday, it became clear that the U.S. Federal Reserve is not going to cut interest rates anytime soon. Why did the market come to this conclusion? Well, the Bureau of Labor Statistics published its May employment report last week, which saw non-farm payrolls surge by 172,000 jobs alongside sharp upward revisions in the previous data. Now remember, the Fed's dual mandate is to maintain stable prices and a healthy labor market. Inflation has been running above the Fed's 2% target for more than 5 years, almost 5.5 years now. And the labor market that's now seen as resilient, this means the Fed has no reason to lower rates, at least in the near term. In fact, with a more conservative chairman in Kevin Warsh, the central bank's bias could be to raise rates before the end of the year. Market expectations shifted dramatically. Traders priced out a rate reduction for the upcoming June meeting, and some members of the committee have suggested that a rate hike is likely before we end 2026. Another concern seems to be that the massive IPO set to soak in investor dollars in the coming months, presents an additional risk. I'll get to that in a moment, but first I want to explain why rising interest rates and a liquidity drain present significant risks to the financial markets. Why higher interest rates are a risk to the economy and the stock market. Rising interest rates tend to have a cooling effect on the economy and the stock market through a number of powerful forces. Capital expenditures by businesses depend on low borrowing costs. Higher rates make it more expensive for businesses to borrow money and to fund growth and to make dividend payments. It can slow the housing market. After all, people don't buy houses, they buy mortgages. Variable rate interest payments on loans and credit card, those rates increase and reduce consumption. Rising defaults can also negatively impact banks that have then reduced lending capacity. When interest rates rise, safer investments like government bonds and high-yield cash become increasingly attractive to investors, and money will naturally flow out of the stock market into those more attractive fixed income investments. Rising interest rates act as a natural cooling mechanism for both the economy and the stock market by making borrowing more expensive. Higher rates put the brakes on business expansion and slow down the housing market, while simultaneously squeezing consumer wallets through costlier credit card and loan payments. As banks scale back lending to manage rising defaults, investors also pivot, shifting their money away from volatile stock markets to safer, more lucrative havens like government bonds and high-yield cash. The hyperscalers are a house of cards. Formed by the merger of two prominent London-based financial firms, Panmure Liberum is one of the largest independent investment banks in the UK. In their May 14th investment strategy report, they presented in-depth research on the AI expansion, providing some eye-opening insights. Their analysts say the AI bubble is already 60% larger than the dot-com bubble. They say that Wall Street's growth expectations are higher than anything seen since World War II. They say the vast majority of data center capacity in the US exists only on paper. Only 4.6% of planned data center capacity for 2030 is under construction. As for the remaining 95.4% of planned capacity, 18% are firm commitments and the rest are merely announcements by the hyperscalers. Those hyperscalers, Amazon, Microsoft, and Google, need an additional 2 to 5 trillion in annual revenue to justify their planned investments. Now, these days, billions and trillions are thrown around all the time, and it's hard not to just gloss over those numbers. But to understand what an additional 2 to 5 trillion dollars in annual revenue would be, to give you some perspective, Amazon's total revenue, all of their combined businesses last year was 0.7 trillion or 717 billion. Google's total revenue last year was $403 billion. That's 0.4 trillion. And Microsoft's was 282 billion, which means they need to double or triple their annual revenue. The conclusion of Panmure Liberum's analysis was, quote, "The data center boom looks like a house of cards," end quote. SpaceX could change the market. The SpaceX IPO is another liquidity drain looming over the markets. To understand the dynamics here, I want to use an analogy. Let's say you live in the hottest neighborhood in New York City. There's only about 10 apartments on average available each month. Now, there's been a consistent trend where there are a few more buyers than sellers, and the prices have been getting bid up. Now developers suddenly announce they're building hundreds of brand new ultra-modern homes right next door. The dynamic instantly changes. New buyers put deposits on the upcoming builds instead of buying the existing homes, and current residents start selling their properties at a discount, abruptly altering the supply and demand imbalance. We're about to see something along the lines of this dynamic play out in the stock market on a scale that we've never seen before, frankly. To put the magnitude of this upcoming grab into perspective, the total IPO volume for the entire last year amounted to roughly $50 billion. In comparison, SpaceX alone is looking to raise an astronomical $75 billion alone. When you throw into the mix that Google wants to scoop up $80 billion in another offering, Meta is planning a capital raise of a similar magnitude, and the AI frontrunners Anthropic and OpenAI are each seeking out just under $100 billion each. In the third quarter, it becomes clear we are in uncharted territory with these IPOs. The fundamental question is not whether these heavy hitters will successfully raise the cash, they almost certainly will, but rather what happens to the market value of the other securities as this capital is simultaneously being grabbed up in the system. This unprecedented capital drain comes at a sensitive time, as the S&P 500 recently pulled off its highs and erased the technical cushion that usually protects the bull market. In a normal environment, institutional investors would step in and buy the dip, to stabilize things. However, SpaceX and this historic pipeline of IPOs throw a massive monkey wrench into the gears. If institutional funds need to raise tens of billions of dollars to get a piece of these massive new offerings, they'll likely have to sell existing securities to do it. This means that marginal buying power that would normally be there to absorb a market pullback might instead be tied up waiting for these mega IPOs. While these critical funding questions get resolved in the weeks ahead, I'll be watching the markets and my clients' portfolios to continue to emphasize the importance of risk management and diversification outside of traditional stocks and bonds. Now for some side notes. Microsoft, which makes up nearly 5% of the S&P 500 index, is overvalued by 41%, according to the acquirer's multiple, who run a dividend cash flow model on a new company from their watch list every week. An investment advisor who fled police on a water scooter was sentenced to 30 years in prison for running a $35 million Ponzi-like investment fraud scheme. If you've been watching my videos for the past few weeks, you know I've been following some pretty witty skeptics. Husk IRL on YouTube has gone viral, showing the limits of AI in real time. In this video, he shows that ChatGPT cannot even count to 100. For some extra laughs, you might want to take a look at the comments section. Finally, if you don't have an estate planner, Robin Friedman at the Wall Street Journal provided a great place to start with her article, The 5 Documents You Need to Have in Your Estate Plan. For links to these stories and everything I've covered today, subscribe to my weekly Market Forces newsletter at alpharockinvestments.com. When you're there, download my quarterly investment outlook, explains exactly how I'm investing for my clients, and please like this video and subscribe to my channel. It helps me reach new viewers. If you have a question or you want a free portfolio analysis, contact me directly anytime. Links are in the description.